Hello and welcome everyone. So in this video I'm going to talk about, well, when governments intervene in markets. So this is looking at the first part of chapter 6 from the text. And so in this video I'm going to talk about how taxes and subsidies change market outcomes. And let's see, I go up to the first, I think it's just taxes. I kind of forgot for a second. Yeah, I'm just going to do taxes here. And the second video I will talk about price ceilings and price floors, and then quantity regulations and so on and so forth. Now, the big thing that I want to point out when we're talking about taxes and we're thinking about taxes applied to the market, there's kind of like two big ideas. The first thing is who pays the tax, who actually bears the economic burden of the tax depends on price elasticity, the relative elasticity of demand versus the relative elasticity of supply. Whichever side is more inelastic, more unresponsive to price changes, is going to bear the larger share of the tax, right? Taxes are just a change in price. And so that's really important. Now, we can officially assess the tax on buyers or on sellers. I'll show two different modeling conventions for that, but who ultimately bears the largest share of the tax comes down to which side of the market is less inelastic. And the reason why is because it comes down to who has the worst alternatives to just paying the tax. In the same breath, I want to say, all right, fine, somebody's paying more of the tax, somebody's paying less of the tax, but it's only the case that one side pays all the tax if that demand or supply is perfectly inelastic. Otherwise, the tax burden is shared. So even if it's a tax that's officially assessed on buyers, such as, let's say, sales tax, sellers are bearing part of the burden as well. All right, that's the first big idea, and I'll develop this through the slides. The second big idea is that if we attach a $1 tax to a particular item, it does not mean that the price that's ultimately paid, that the price paid by buyers goes up by $1, right? So if gas is selling currently for $2.50 and we place a $1 tax on gas, it does not mean that the new equilibrium involves gas trading at $3.50. The reason why is because when we raise the price, quantity demanded is going to fall. So we're going to get something less than $1 increase, right? And because this tax burden is shared. So I'll show this to you, but that's going to be really important as I develop the graphs here in a second, is that you understand, firstly, who bears the burden of the tax comes down to which side of the market is more inelastic. Secondly, if we add a tax of, say, $1 or $2 to the market, it does not mean that you simply add that size of the tax to the equilibrium price and get the new price. That's not at all how it works. And so those are like the two common things we want to kind of get out of the way from the get-go. All right, so first question, suppose we have a tax on sellers. How does a tax on sellers affect the supply curve? Well, if there's a tax on sellers are going to have to pay some amount to the government for every unit that they sell, right? Think of supply. Supply is just a relationship between prices and quantities supplied. So for each quantity supplied, there's the price, and then there's going to be an additional amount. What this is doing is it's like an artificial cost. It's like another input. It's like the tax is part of an input that you're buying. You have to buy materials, raw materials, to make whatever is the thing that you're selling, and now you're also buying like tax. Well, you're paying the tax. It's like you're buying another input. It's going into the cost. It raises the cost, therefore leftward shifts the supply curve, right? So it leads to a decline in the quantity sold. The tax increases the price that buyers pay, decreases the price that sellers receive. So here's an example of a tax on sellers, right? So suppose we've got this market. Currently the equilibrium is at, let's say this is soda. Currently the equilibrium's here. I don't know what this quantity is. Doesn't matter. Here's the equilibrium price. It's $1.10. Now we add in a 30-cent tax. We're going to leftward shift the supply curve by 30 cents. Now, for a second, you might think that contradicts what I said a minute ago, which is that you don't simply add 30 cents to the equilibrium price and get the new price. That's all still right. You add 30 cents to the supply curve. You raise this vertical intercept by 30 cents. That's what we're going to do. Okay? So the supply curve shifts to the left until it lies 30 cents higher as measured on the vertical axis. The tax raises the marginal cost for each seller by 30 cents. They'll only sell if the price is 30 cents higher for each bottle of soda. And so that's this picture. Now it's not drawn here, but this should cross 30 cents higher than whatever this was. Okay? Now the new equilibrium price, the equilibrium with the tax, is going to be here. This point is not 30 cents higher than this point. Look carefully. So this dashed line is the equilibrium price, right? The original supply was below, the original supply is above. We know the distance between the supply curve, old supply curve and new supply curve. Yes, this is 30 cents, right? Because this is a 30-cent shift. But the distance between the old price and the new price is less than 30 cents. The reason why is some of the tax is going to be borne by the buyer. Some of it's going to be borne by the seller. All right. So the supply curve shifts until it lies 30 cents higher as measured on the vertical axis. Tax measures the marginal cost for sellers by raises the marginal cost by 30 cents, so they'll only sell if the price is 30 cents higher for each bottle of soda. The equilibrium occurs at a point where the new supply curve meets the old demand curve. So we've got that. Okay, good. I'm just going to go kind of to the end of the graph portion. The quantity of soda purchased falls. Oh, this was 1.4 million down to 1.2 million. So we'll label this now. Okay, so what's happened is we've reduced the quantity. Of course, there's a higher price, so we're going to get a lower quantity demanded. That's right. The price buyers pay rises by 20 cents. Actually, it turns out this equilibrium happens at $1.30. It rose from 110 to 130. The price sellers receive after the tax falls by 10 cents from 110 to $1, right? The vertical height between the old supply curve, think of the supply curve as capturing the cost of production. Now we've added in this artificial cost of production, the tax, that brought us up 30 cents higher everywhere. So that's our new supply curve. Now, this gives us our new equilibrium, which was found at 130. This is actually what buyers are going to pay, $1.30. That's not 30 cents higher than the old equilibrium. Previously, buyers were paying 110. Now buyers are paying 130. Why are buyers not paying 140? Buyers are not paying 140 because we don't just add 30 cents to the equilibrium price. We add 30 cents to the supply. It shifts the supply curve, so the new equilibrium price is here. 20 of the 30 cents are paid by buyers. They're paying 20 cents more. 10 of the 30 cents are paid by the buyers, okay? Because they're are paid by the sellers. I can't talk. So anyway, it's a 30 cents distance between $1 and $1.30. That's the size of the tax because that's the vertical distance between this supply curve, inclusive of the tax, and this supply curve. And this is the new quantity actually traded. That means this is going to introduce deadweight loss, inefficiency, because what's happened are these 0.2 units between 1.4 and 1.2 are no longer traded or sold. This triangle and this triangle, this right here, this is lost economic activity, right? This rectangle right here, this is the tax revenue. So the tax revenue generated by the government is going to be 30 cents times 1.2 million, I guess, right? Length times width, the area of this rectangle. The surplus, the buyer surplus, is going to be this area under the demand curve and above the price they're actually paying. The seller surplus is going to be the area under the price they actually receive and above their costs. So this is economic surplus to buyers, this top triangle. This is economic surplus to sellers, that's this bottom triangle. These two rectangles together, this large rectangle is tax revenue to the government. That's all economic value. These two triangles are loss, deadweight loss, it's inefficiency. So there's actually a trade-off from the standpoint of the government's perspective. How large can they make this rectangle without making these triangles too big? Unless the triangles being big means that there's goods no longer being traded. So maybe we're trying to tax this so that people don't consume it, in which case you want this area to be big. I don't know. So whatever is the case. All right, so how does the tax on the sellers affect the supply curve? Well, the tax shifts the supply curve to the left. It reflects a new higher marginal cost. The tax leads to a decline in quantity sold. increases the price buyers pay, decreases the price sellers receive. Both buyers and sellers bear the economic burden of the tax on sellers, right? 20 cents to the buyers, 10 cents to the sellers. What about a tax on buyers? Tax shifts the demand curve to the left to reflect the lower willingness to pay for the good in the presence of the tax, because you're buying less good because some of the money coming out of your pocket is going to tax. You're buying the good and tax. It's like you're buying two things. You're buying whatever you meant to be buying, plus you're buying this other thing, tax, which is just money that's going to evaporate and go to the government, right? So the tax leads to a decline in the quantity sold. Tax increases the price buyers pay, decreases the price sellers receive. Both buyers and sellers bear the economic burden of a tax on buyers. You can see that with a graph here. So the new tax on buyers, here's if we model this 30-cent tax on buyers, this would lower the demand curve by 30 cents. So again, I don't just subtract 30 off of the equilibrium price and move down. No, not, or at least not for the price. I move this demand curve down 30 cents. So yeah, it's going to be 30 cents lower here, but importantly, my willingness to pay is going to fall by 30 cents. My maximal willingness to pay to this right here. All right, let me just kind of get the full graph here and kind of talk through it. The new equilibrium occurs at the point where the new demand reaches the new supply. That's going to be right down here. The equilibrium quantity fell from 1.4 to 1.2. Good. The price buyers pay with taxes rose by 20 cents, right? This is the old supply curve plus the tax-inclusive demand curve. This is telling us, basically, when there's this 30-cent tax on this good, we're only going to be able to afford a quantity of goods equal to 1.2 million bottles per week because we're going to buy bottles plus tax. And when you buy bottles plus tax, this brings me up to the amount that buyers are actually paying. That's this $1.30. So buyers are paying $1.30. 30 cents worth is going to the government then to cover tax, and then $1 worth is going to sellers to cover goods. So they're getting $1 worth of goods, so their willingness to pay for goods only would be like right down here, plus the tax brings us to here. That's what's working here. Price sellers receive falls by 10 cents. Price buyers receive gains by 30 cents. And this picture is exactly the same. This is still with a different curve, sorry. And so this is the rectangle for taxes. This is still producer surplus. This is consumer surplus. These two are deadweight loss. This is still foregone activity. And you'll notice it didn't matter if we modeled this 30-cent tax as shifting the demand curve or the supply curve. The quantity traded is still the same. The price buyers pay is the same. And the price sellers receive is still the same. And that's an important lesson. So regardless of whether the tax is on buyers or on sellers, both buyers and sellers bear an economic burden. Who experiences a greater loss from the tax? Well, the statutory burden describes the burden of the tax assigned in terms of who's got to send the money to the government. The economic burden tells us, well, who's affected? What's the change in the after-tax prices? Tax incidence is the division of the economic burden of a tax between buyers and sellers. So here's statutory burden and tax incidence. When there's a new tax levied on buyers or sellers, the economic impact is the same. It doesn't matter whether the buyer or the seller is assigned the responsibility to transmit that payment to the government. Notice the final impact on prices and quantity. 1.2 million was the quantity. Is $1. It was $1. Sorry, dog's barking. It was $1.30 to the buy that the buyers are paying. It was $1.10 it's $1.30 that the buyers are paying, and it was $1 that the sellers are receiving either way. Neither buyers nor sellers should care who has a statutory burden. It doesn't matter who's putting the money in the jar. It matters whose side is more inelastic. So here's an example. To fund Social Security system, 12.4% of what you earn is paid into Social Security, half paid by you, half paid by the employer. Why do you think Social Security taxes are split this way? Does it matter how Social Security taxes are split in terms of the burden to you and your employers? You think of wages as a price for labor. So this is just like any other market. Actually, it doesn't matter. What matters for who bears the burden is going to come down to which side is more inelastic, you or your employer. Why are taxes split this way? Oh, it's politically expedient. So it's it's a lot easier to get this passed to say, we'll pay half, you pay half, because people like the 50-50 split, even if it's just 50-50 in kind of name alone, when the reality is one side or the other bears a larger burden. Tax incidence depends on the price elasticity of demand and supply. Sellers bear a smaller share of the economic burden when supply is relatively elastic. Why? They produce something else instead. They can avoid it. Elastic supply means sellers have alternatives. Buyers bear a smaller share of the economic burden when demand is relatively elastic. They can do something instead. They can get away from the tax. So here's the example of price elasticity and tax incidence. So here we have a relatively steep demand, relatively flat supply, and this tax is going to be borne largely by demanders. Here we have a relatively flat demand, a relatively steep supply. This tax is going to be borne relatively by sellers because their demand is more inelastic. And so here's the pictures. So we have when tax is relatively inelastic, when demand is relatively inelastic, supply is relatively elastic, the price for buyers goes up by a lot. When demand is relatively elastic, supply is relatively inelastic, the price for buyers goes up by a little and sellers bear a larger share, right? And so look at the share of this 30-cent tax. It's a 30-cent tax in either way, but when demand is relatively flat, supply is relatively steep, when demand is relatively steep, supply is relatively flat, most of the tax is borne by buyers. When supply is relatively steep and demand is relatively flat, most of the tax is borne by sellers. Okay. So here's our three-step recipe for evaluating taxes. Firstly, is supply or demand shifting? So is the change affecting buyers or their marginal benefits? Any change affecting buyers or their marginal benefits shifts the demand curve. Any change affecting sellers or their marginal costs shifts the supply curve. Is a shift an increase or decrease in taxes? Well, an increase in taxes shifts the curve to the left. Decrease in taxes shifts to the right. Right? Increase in taxes is like an artificially raise in price, in costs. A decrease in taxes is like an artificial decrease. How will the prices and quantities change in the new equilibrium? Well, we've got two post-tax prices. Buyers pay one, sellers pay the other, and the wedge in between is going to be the size of the tax. So Michigan introduced a new tax of 5 cents per gallon of gas sold in gas stations. Sellers pay this tax directly to the government. How does this affect market outcomes? Well, we'd use our three-step recipe to find out. So we'd shift the supply curve leftward by 5 cents. The price that buyers would pay rises from the old price. The price sellers receive falls from the old price. So the supply curve shifts because the tax is paid on sellers. It's paid by sellers. Extra tax on sellers will raise their marginal cost, decreasing supply and shifting the supply curve to the left. The quantity of gas sold decreases so that the price sellers receive will fall, the price buyers pay will increase. And who's paying these 5 cents? Well, it's the sellers that are giving the 5 cents to the government, but how much of each is well, I guess it's not in here. How much of each is being paid is going to depend on which is more inelastic, supply or demand. For that, we'd need to have our supply curve. We need to know our demand curve. If demand was more inelastic than supply, we'd expect buyers are going to pay more of the 5 cents. If supply is more inelastic than demand, we'd expect the sellers would pay more of those 5 cents. Demand's pretty inelastic for gas, at least in the short run. People don't have really good alternatives. You have to pay for gas to get to work, right? Or for commutes or whatever. So, all right. Suppose the demand for candy is less elastic than the supply of candy. If a tax is imposed on sellers of candy, maybe because of sugar, which of the following is true? Oh, well, if demand is less elastic than supply and the tax is imposed on sellers, even though sellers are transmitting payment to the government, sellers are going to pay the larger share. Sellers, demand is less elastic. Sellers will pay a smaller share. Demand is less elastic means demand is more inelastic. Inelastic demand means buyers have a sweet tooth. They have fewer alternatives to buying the candy. They're just going to keep buying the candy. Sellers have other things they could do. Maybe they make other products that are not candy, so they're not taxed. Sellers bear a smaller share of the tax burden because supply is more elastic than demand. All right. Subsidies, next I'll talk about subsidies. They kind of work in reverse of taxes. So subsidy is a payment made by the government to those who make a specific choice. And just like with taxes, it doesn't matter who gets a subsidy, buyers or sellers. The benefits of subsidies are divided between the sellers and buyers based on the elasticities of supply and demand. So what are some examples of subsidies you or someone you know has received? I mean, there's lots of subsidies, like different types of credits, healthcare, childcare, green initiatives in terms of like solar cells or whatever. Lots of different subsidies. So suppose there's a new subsidy introduced, and suppose this is for the market for childcare. A subsidy increases the willingness of parents to purchase childcare at any given quantity, to be willing to purchase childcare, even if the before subsidy price is $3,000 higher. So this shifts the demand curve to the right until it lies $3,000 higher as measured in the vertical axis, right? So the idea is, here's the old price, here's the equilibrium without the subsidy. Now we're going to give parents a $3,000 per year subsidy, which is going to increase their demand for childcare. So this is subsidy for buyers. Seller supply curve is unaffected. I'll just kind of go to the end here. The quantity of childcare purchase rises because we've got a new demand curve, right? We're raising the willingness to pay by virtue of subsidizing some of the amount that you actually have to pay. This is going to increase the quantity of childcare that's going to be demanded, because this looks like an increase in demand, increases the price as well. So the price will rise from $10,000 to $12,000. Sellers receive now $12,000 per child in care, increase of $2,000 per child. Parents now pay $9,000 after receiving the $3,000 subsidy from the government, right? Parents the price dropped from $10,000 to $9,000. And note, the buyers and sellers share the benefit of this subsidy, right? So the interesting thing, let me just kind of go over the example. We had the childcare market. Originally, the equilibrium quantity in millions of children in childcare was 13. The old price was $10,000, say a year or whatever. Government gives a $3,000 subsidy to parents. The wrong intuition would be to say, oh, now parents pay $7,000 for childcare. That's wrong, because that's not how we model this. We think of the $3,000 increase as raising the willingness to pay. And by raising the willingness to pay, this is also an increase in demand. So now more is purchased, right? So what's happened is we've shifted our demand curve by $3,000. A larger quantity of childcare is purchased, corresponding on the original supply curve with a higher price. Now the price is $12,000. So the benefit to the seller is $2,000. The benefit to the buyers is only $1,000. Although there might be substantially greater benefits to buyers who are now, have time for working rather than their own, providing their own childcare, and therefore generating human capital by virtue of school or work experience or whatever. All right, so which of the following is a government subsidy? So Joy smokes 2 packs of cigarettes each day, thinks of cutting back to 1 pack. A new cigarette tax takes effect. No, that's a tax. That's not a subsidy. Zach lives in Bronx, goes to college. New York City gets free MetroCard. Okay, yeah, that's a subsidy. Getting something that's going to reduce the transaction cars. Alex wants to go to Machu Picchu in Peru. Can't commit because there's a daily limit. No, that's a quantity limit. That's not a subsidy. Yeah, this is the only subsidy. All right, and it says practice question 2 of 5, but that is the extent of the questions we've got here. So I'll stop with this example. I hope you enjoyed this video, and I'll pick up in the next one to cover what was remaining. It was price controls, right? So the next video talks about price controls and quantity regulations.